While there is big mortgage relief coming for a lot of people, as a whole bunch of new guidelines have been set in Canada. And man, you got to hear this straight from the horse's mouth. Now, we knew that there was trouble in the market. If you've been following the market and this channel for a reasonable amount of time, you know that this is the case. All right, so let's listen to Chrystia Freeland, who is very, very big in Canada. She's a deputy prime minister, so second in charge. Let's hear what she says is happening right now.
New support for Canadians with mortgages. In our spring budget, we announced that the Financial Consumer Agency of Canada would be publishing a code of conduct to protect Canadians with mortgages at a time of elevated interest rates. Today, the FCAC published a guideline which details the support that banks and other financial institutions should be providing to Canadians who are struggling with rising mortgage payments.
This
Specific
is like
mortgage relief
everybody.
measures could include waiving prepayment penalties, not charging interest on interest, waiving internal fees and costs, such as mortgage renewal fees and internal costs associated with late payments. The guideline published today is intended to protect Canadians by ensuring their financial institutions treat them fairly and provide them with the tailored mortgage relief they need, all with the goal of helping Canadians who are really struggling to manage their mortgages receive the support they need.
All right. So as we hear that, now she's talking about the new guidelines and all of the relief measures that are coming out right now. And I think this is really important for everybody to understand, right? So the important part for you, for me, everybody, I know that she's trying to say that there's certain people who are suffering from higher mortgage rates. I can tell you from talking to hundreds and hundreds of clients, almost everybody is feeling it. And I'm talking about people who are well off and have a lot of properties. They're suffering too because this is hurting everybody equally. All right, so let's take a look at some of the specifics of what they were saying, because I think it's really, really important that we pay attention to that part. All right, so this is the main part. In the mortgage relief, it has to be your principal residence. You can waive penalties, waive the mortgage breakage fee. That's if you decide to sell your house, let's say, waive internal fees, not give you a higher rate because later on, and not show on your credit. They don't want this to hurt you down the road. Now, these are all very, very lofty goals, I have to tell you, but who's going to pay for it? And that's always the question. Now, I want to get back to something that might be a little bit confusing. This is when we are going to go on a ship. If you're on a ship, there's going to be a captain. Would we agree? Yeah, that captain wants you to get to one place or the other. Also, there may be staff that is helping you to make sure that you have a wonderful experience while you're on this ship, whatever it may be. At the same time, you might have some engineer that is down in the bowels of the ship working on the engines of some kind, and he's trying to make sure this thing all stays together. But at the end of the day, what I'm trying to say is you're on one ship, it's heading in one direction, but you have three kind of competing interests because the captain, all he's telling you is which way you have to go, period, right? That captain has made his call. He's like, this is where we're going, waves or no waves, it is what it is. At the other side, you may have a conflicting agency who is like, yeah, but we're not treating the clients better. Remember the Titanic, he just wanted to get there fast, but it caused problems. So there may be some conflict between what the captain wants, how to get there the fastest with the most waves, with making it a pleasurable way. But at the same time, those two may have a conflict with the guy who's in the bowels of the ship, who's actually trying to work on the mechanics of how it works. Now, can you see what I mean? How there could be a conflict between these three people. And I think this is where it comes down to a lot of the misunderstanding of where we are right now. All right, so obviously everybody knows that all of the countries all over the place have a central bank. The central bank, there's a central bank of central banks that's in Europe, but there's also a central bank of Canada, a central bank of the United States. These guys are the captains. Yes, sir. They're telling you which way they need to go, right? But then comes these other federal agencies that we kind of hear about, but nobody really understands who they are. All right, so let's get into who these guys are. And I just want you to go and type in into Google, who are these people that she is referencing? OSFI and FCAC. Who does she keep talking that? So OSFI are like the police. Now, their mandate is focused on prudential matters in the financial services sector. They're kind of like the engineers that are making sure that everything works good. But if you go on and look at what do the Financial Consumer Agency of Canada, they're the ones that are protecting the rights and the interests of their consumers. So the Financial Consumer Agency, they are kind of like the employees that are really trying to make sure that you have a wonderful experience when you're at the bank. And who is the Office of the Superintendent of Financial Institutions, OSFI? Well, OSFI's mandate is focused on prudential matters in the financial services sector. If I could liken them, they're like the engineers making sure that everything can work together. All right, so now that we know these financial services, one is based on the rights of consumers and one is based on being prudent with financial services. All right, so where is this guide that they keep talking about? We have to know what the guide is saying to us today to contribute to the protection of consumer and financial products by providing tailored support to customers at risk. So this is, remember, this agency is only here to try to make your life better as a consumer. This is the guidelines that they're trying to put out. But I also want you to remember at the exact same time, who's paying for this? I want you to think of that as we go along, okay? So they want at-risk people, but here is a very big key. They have to have a residential loan on their principal residence, okay? Big key. Also, they want those whose payments on variable rate mortgages that are fluctuating. These are the people that they have to go after. And they may be facing negative amortization. As we know, this is all over the place right now. Everybody, we've done videos on 60, 70, 80, 90 year, 100-year mortgages. And so these are the people that they're trying to go after. So they want the banks to monitor and identify people in advance to let them know, hey guys, you're missing your payments. But I got to tell you, I think that those people already know, and they want to offer mortgage relief measures. And so what are those measures? Well, we're going to get to those in a second. So of course they want it to be fair. They want everyone treated the same. Now here comes the money part. They want to waive prepayment penalties. Okay, if you guys aren't sure, when we have a mortgage, generally what happens is they're like, you sign for a 5-year and you want to break your mortgage after one, we're going to charge you a penalty for that. Because remember, when you're signing on that dotted line, you're guaranteeing the bank 5 years of profit. They don't want to let you go without making their full profit. So this is where it comes down to this one part, right? I mean, the government, this agency wants the banks to do this for them. So they want to waive the payment penalties if you make a lump sum payment, waive the penalties if you sell your principal residence. Also, they want to waive any internal fees or costs for a limited amount of time, notice limited period. It doesn't say how much. So they're going to be able to figure out what that actually means. For a limited period, relief measures result in negative amortization, which means the 80, 100-year mortgages that we keep talking about. But here is the kicker: to ensure that no interest is charged on interest. Woo! That's a massive one. Big money for that one. Also, at the time of renewal, they expect that a bank will not offer a less advantageous rate based on their inability to adjust their mortgage credit agreement or qualify with other lenders. So they don't want you to give you a predatory rate either. Wow. So when you go through this list, this means the bank every line I put here in yellow means the bank makes less money, makes less money, makes less money, makes less money. And this is what they're asking for. Now, notice the particular verbiage. They want to ensure that total amortization period is reasonable. What does reasonable mean? I mean, we have 100-year mortgages right now. So, I mean, every one of those words is going to be picked apart by the bank for their own advantage, right? And this is just the way that it goes. They want to make sure that you include information about options to restore your amortization period to its original time. Let me save you the trouble. Pay double or triple the payment and you'll get it back down to 25 years. I mean, it's not very complicated. Make a massive lump sum or increase the amount every single month. Those are your choices. Also, included in the assessment and communication for a potential long-term negative financial implications. Well, yeah, if I can't pay for my mortgage, there are going to be negative financial implications. I could go broke. So they want also the banks to provide education tools and resources to support sound financial decision making. Here's the good part: you guys already found me, and I'm helping you along the way. So I'll be able to help you at least justly, instead of having, let's say, a biased opinion when it comes down to that. All right, this is the guide. And so when we're going to step through this guides, waiving fees for lump sums and prepayments. This is huge. These fees could be $20,000, $30,000. Waiving fees when you're selling a house also could be like $30,000. Extending the loan timeline. Now, they can do that, but remember, they cannot charge interest on the interest anymore. That's what they want to do. That's a big, big thing. So in under negative amortization, this is the 100-year mortgages. So when we look at that, it says that they're only able to cover the interest portion of their loans right here. This means the principal balance of their mortgages remains unchanged or even increasing. And like we have talked about many times on the channel, Toronto, TD Bank, Bank of Montreal, CIBC, Royal Bank, and others have a significant portion of their mortgage portfolios falling into this category of negatively amortized mortgages, which means people are defaulting on their mortgage. How much does the government say? It says a significant portion. Yeah, it's not just nothing. So when we're going to take a look at this, you guys, we have to pay attention to this, because this is happening, and this is what I've been telling you about now for quite a while. Now, they're going to make all of these procedures. Remember, all of these different agencies have different mandates. The government, the big kahuna, they're setting those interest rates and smashing inflation. That's what they're saying. But the other office is like, no, we have to do things properly, and we're going to guide the banks with a framework. And then you have the Consumer Protection Agency, which is what we're talking about today. But it all seems like you'd think that when governments, and this isn't Canada, guys, I'm not picking on Canada. This is not a political channel. This is a money channel. So if this doesn't matter if we're in Europe or if we're in Japan or if we're in the United States, you have different agencies with different mandates. So they all don't kind of operate on the same road. They're all fighting for their own mandates. And so this is to be expected, no matter where you are. So this is where we're at right now. Now, you guys know that I was talking to you about these articles about 60, 70, 90-year mortgages that are continuing. Right now, this is kind of what would happen. Imagine that you had a fixed payment. I know it's a joke. The prices are very little here, but $17.24 for this. And you're going along, and the yellow here is your principal, and the blue part is interest. But as they start raising rates, you notice your payment stays the exact same, this black bar that goes across. But as interest goes up, it just keeps on going up until when you have no principal being paid off at all. You notice that the interest that you owe is greater than your total payment. So they just stack it on the end. And there comes when they talk about interest on your interest. So if your payment should be $5,000 a month, but you can only afford $3,000, they take that $2,000 and stick it on the end. And now you got to pay interest on that. And now that whole $2,000 isn't just principal. A large part of that would be interest as well. So now you're going to pay interest on the interest that you have accrued. That's what they're talking about. So a lot of people are seeing their actual mortgage balances go up every single month. And that's a very dangerous thing. We've done a lot of videos on that in the past, on how you can only get these special 90-year mortgages, whatever that is, between your renewal dates. You can never qualify or renew at something greater than 25 years, 30 in some circumstances. So where are we today? If we want to take a look at where we've been in the past month, mortgage rates are very, very tied to bond rates. If you take a look at where that is, I mean, it has been on fire lately, like going up by 1 whole percentage point from 2.8 all the way to 3.9, screaming higher. That 1% pushes your mortgage prices up by 1%. So where is Canada right now? Canada is sitting at 4.75, but this is just the rate that the banks borrow at. This is the prime rate that the government set. But we're really short of where the United States is. The United States right now is at 5.25, and their jobs report just came in today, and it was so hot, it was double what they were expecting. So if it's double the jobs, and remember, the governments want people to be out of work. They want Canada to lose 200,000 jobs, and the United States got to lose 2 million to get them into better balance, to use their words. So they want a softening of the job market. It just means they need more people out of work. So this is going the other way. And so this is almost a guarantee that they are going to be raising their rates again in the United States imminently. And so because of that, Canada normally has to follow exactly what the United States does. So if we're at 4.75, they're at 5.25, and almost surely now are going to be raising those rates again. We now have 3/4 of a percentage point to make up for that loss. Now, as you can see, this map, this is fixed rate variables that are in blue, and the red is variable. And now the variable rates are higher than the fixed rate, which is absolutely cuckoo, but they are catching up. They're screaming higher right now. So this is a very, very weird market when fixed rates are low. That's crazy. That never happens. Fixed rate is a security blanket, I always say, and you got to pay for that privilege. And so right now, the fact that it's low is unbelievable. Now, Canadians have a love affair with variable rate mortgages. It's always been that way. And so this is going to continue. Remember, as a very, very rough number, this year, the major banks in Canada have about 30 billion each that is coming up for renewal. Next year, about 60 billion each is coming up for renewal. And in 2025, the big kahuna, 100 billion from each bank is going to be coming due. This does not take into account the most toxic category, which is commercial real estate. And please remember that we don't need a lot to happen for big things to happen. What do I mean by that is back in 2007, 8, 9, when we had the great global financial crisis, when that happened, it was only 4% of properties foreclosed on in the United States, 4%. So that 4% changed the world forever. And that's when we started all the money printing that we have today. What I mean by only a small amount of homes, 4%, tanked the entire world market by 30, 40, 50%. So big things can happen when little things happen, right? That's like if the butterfly flaps his wings 1,000 miles away and a hurricane starts. This is what that is. And so I want you guys to pay attention to this now. Remember, there's 3 different organizations, and this is in every single country, that you'll have the government, you'll have a regulator, and then you'll have a consumer protection in the majority of countries. So this is why it kind of adds to a lot of the confusion. This is a lot of the questions that I'm getting today. And so they're all going to be trying to have their lawyers go over those small print. And what do those mean reasonable? What does that mean? Or who is defined as at risk? All of that has to be hashed out by lawyers on both sides, as the banks are desperately going to try to keep up to this. Now, how fast will this happen? I don't know. Remember back in April 1, they started the first home savings account. We've done videos on that before. But on the first home savings account that is out there to actually help people purchase homes, some banks were very quick to get those programs out. Other banks like Bank of Montreal still haven't even been able to get it together since April, and said maybe by the fall. So, I mean, it takes time for them to implement all this stuff. How much is that going to implement it? So when I was mentioning to you all of these different changes that are going to be coming up right now, and there's a lot, right, in these guidelines. When you're talking about all of these different things, means the banks make less money. If they actually instituted all this, where they would waive all the fees and penalties if you broke your mortgage, all the penalties if you sold your property, waived all of your fees and have no internal fees, it's going to cost the bank more. Limited negative amortization where no interest is charged on the interest. Oh my goodness. Again, this is going to be subsidizing the people that are in trouble. At the time of the mortgage renewal, they don't want you to charge a higher rate, and they don't want it to put it on your risk overall. Now, this comes down a little bit into wherever your moral compass is. And this has turned into a political issue, and we don't want it to be. We're talking about money here, right? But at the end of the day, the banks, either their stock is going to tank because they're going to make a lot less money, or they have to raise the rates on everybody, even people who have good stuff. And this is exactly what is happening in the United States. In the United States, if you have good credit through all of time, you get a lower rate. If you have bad credit, you have to pay a higher rate. They're trying to change some of that. And if you have a good credit score, now you got to pay more in order to help pay for the people who have a bad credit. And so they're trying to even it out. So it's just more taxes on one group and trying to redistribute it. Most likely, that's what the banks are going to do. The people that own stocks in those banks are not going to just sit back and say, it's fine if we lose a lot less money. They're going to have to find creative ways to make more money on the other side. So do I think that the banks are going to actually suffer a lot from this? I think they're going to find new ways to make new revenue streams off the people that they can. Anyway, I'm going to be here helping you through this over the next 2 years. I always say it's going to dictate the next 2 decades of your life. It is that important. I wish you guys the very, very best. Keep on learning, keep on asking questions. If there's anything I can do to help you, I operate in the city of Toronto. You can reach us right here. This is where we specialize in selling properties for more money, less hassle, and faster than the competition. You can go to the website and it's absolutely free. Wish you guys all the best.